Okay, let's get started. Let me just share my screen. Oh, perfect. All right. So whoever jumps in late, they'll just have to catch up with everything that's been discussed today. Okay, guys. So we are officially in week 8. So we have literally 2 lessons left after this week. And then I think it would be not safe to say, but I would be very pleased to say that you guys should literally have all of the fundamentals of what is required to actually get yourself to start trading. So, as I mentioned in previous lessons before, whilst you will have all of this knowledge and this understanding, it's going to take at least, I would say, another 6 months before you will be able to fully be independent and be able to do it yourself without the additional support from the community as well. But again, following these lessons, my support is always here. As you guys already know, we always share charts in the chat from week to week. So if you've got any questions, even following the 2 sessions after this, definitely do not be afraid to ask any further questions. So today's session, we're going to be talking about strategy. So for strategies, we're going to be looking into intraday versus swing trading. We're also going to be looking into entry and exit rules, scaling in and out of your trades, risk versus aggressive risk entries, and we're going to be ending with mindset as we always do, which focuses on confidence in execution. So really sticking to your plan. So intraday versus swing trading. So a lot of you guys have very different routines. Some of you guys might be working 9 to 5, others might be doing night shifts. Some of you might be students. Our routines are all different. It's going to differentiate from another individual that's currently on this call. Now, because of your routine, that is going to dictate how you trade and the sort of trades that you get involved in. So, with myself personally, I do a combination of intraday trades and swing trading. But with that being said, I know there's also some people on this call which might have a preference of swing trading, and there's others which may have a preference of intraday trading. So, the main difference of intraday and swing trading really comes down to, as I said, how much time can you commit to the charts and the sort of personality that you have as a trader. So if you're somebody who really wants to be active and you've got the time to check the markets frequently every morning, maybe scan it and track it in the afternoon, into the evening, and you prefer to close your trades within the same day, then intraday trading is definitely, well, more than likely for you. So you're going to be dealing with shorter time frames. So with intraday trading, when you do get involved with your 5 or your 15 minute time frame, generally speaking, you might be in a trade for 30 minutes, you might be in a trade for a couple of hours, but your aim, your goal is to really be in and out of that trade or a couple of trades before the end of the day. So with this sort of mindset, you've really got to be sharp with how you trade and you've really got to be disciplined as well. When it comes to swing trading, really, on the other hand, is for those who really like to zoom out of the bigger picture and play the longer term game. So, when you are swing trading, you'll generally speaking, your trades will typically last from a couple of days, maybe even going into a couple of weeks as well. So, it does require a lot more patience and it does require a lot more emotional control. Because the way you'll be handling your trades is that you're going to be holding them through the corrections and also you're going to be holding them through the overnight volatility as well. So a lot of these these different styles and these methods of trading really boils down to how you are as a person and what sort of time and availability do you have in the markets as well. So, as I said to you, myself, I do a combination of both. For me, neither is better. It's all about what fits you. But regardless of what one you go for, you need to make sure that your structure is always there. You've always got that discipline, and there's always a clear process from when you are analyzing the chart to then putting in your trade to then coming out of your trade as well. So the markets, it doesn't really care what style you pick. What really matters, which is what I've gone over time and time again, is your consistency. How consistent are you in the markets? So I will show you a chart, and with the chart, I will show you, will basically give you a very clear idea of how you may do handle your long-term trades or how you may handle your short-term trades as well. So this, remember, this is just an example. It's just to give you an idea. So if this is the Germany 40 chart that we're looking at now, right? So with the Germany 40 chart, if I am a intraday trader, this is a 4 hour time frame. So this is a daily time frame, this is a weekly time frame. As you guys know, the way we identify our trades, we look at the trend, we look at the impulse, we identify the correction, we look for the pattern within that correction, we wait for a break within that pattern or the break of a trend line, and then we take our trade, whether it's a buy or sell. So that's how we take all of our trades. We make sure that there's confluence, we make sure that the longer term time frames are matching up with the shorter term time frames. So on a weekly, this is a uptrend, so strong buy right now. On a daily, we're in a uptrend. We kind of got a correction. We broke it, and it's currently correcting within this area here with the anticipation of it doing one more up. But this is a daily perspective. Now, if I'm a short-term trader, I already have an idea of what it's going to do long term, but I'm going to go into my 4 hour. When I go into my 4 hour, I'm looking at all of this here. So this piece, this one move here, this is what I'm looking at here. Now, if I want to, let's just say, if I believe that I'm looking at this piece here, and I think there's one more down before it goes up, as a short-term trader, if I think there's a one more down, I'm more than likely going to take that move to the downside, and I'm probably going to stay in it anything between maybe even 15 minutes, half an hour, or 1 hour. So the way I'll take it, I'll go into the smaller time frame. I'll look at this trend here. So I'll see that it's done a down move. We've done an up. Within this up move here, we've got a 1, 2, 3. We've got our trend line. It's currently broken it. So I might say to myself, as a short-term trader, I'm going to sell it just for it to come down there. So now that settle is probably about, if we look at here, so that's 255 to 175. Let's just say that low there, 157. That's only 100 points. 100 points is a good take profit for a day if you're trading every single day. If you're doing 100 points a day with your 1 to 3% risk, then you could say that's quite good profits that you're making per day. Remember, you have to look at your risk as well. So you have to ask yourself, what am I risking for the reward? But that's how I'm basically looking at this trade. I'm looking at this as a short-term sell and then potentially for it to do another buy to the upside again. So if I'm a long-term trader, I probably won't take that sell. I'm not going to look at that. So if I'm looking for more buys to the upside, I will probably let that move play out and then say, okay, once that plays out, I'm looking for a correction for this to go back up again. Now, once that goes back up, from a 4 hour or a daily perspective, it's going to take at least 3 to 4 days for it to complete that sort of move. So if we look here, each and every one of these candles, as all of you guys should know, represent one day. So all of this move that it's doing here, where it's going up or it's going down, it's going to take at least a week for it to complete that before we try to understand what is it going to do over the next few days. So if we do see a correction play out within a daily and we scroll to the lower time frame, and then the lower time frame shows us that we're ready to go up again, then as a longer term trader, we can start to look at that for more potential buys to the upside. But we want to make sure that the smaller time frames is consolidating and it's aligned with our bigger time frames. So that's how I would take a trade. So a long-term trader, to my point, might say I'm not really bothered about the small moves that it's going to do within the next 30 minutes or a couple of hours. Whereas a short-term trader might say, okay, even though you are ignoring that, what's happening over this next couple of days, I'm going to take advantage of that. And the only way in which you will be able to differentiate yourself from the from the short-term trader is by the amount of time you have available every day and by the amount of the personality you have towards the markets as well. So that's to make things very clear. So guys, when you are trying to be a long-term trader, just be aware that there will be a lot of movement happening within the markets, and you just need to hold it out. Long-term trading is basically investing. It's the I would say it's the exact same scenario as investing in stocks and shares. When you're investing in stocks and shares, generally speaking, you're holding it for a period of months, maybe even going into years as well. So it's the exact same analogy, the exact same concept. Whenever you're trading in forex, crypto, indices, or commodities, you've got the exact same mindset that you're looking to hold it for a few days, going into a few weeks. So, is there any questions that any of you guys have in regards to short-term traders, like an intraday trader and a long-term trader? Because I think it's very important for us to really understand exactly where do we fit in when it comes to trading. No, all good? Cool. All right, perfect. So just be aware of that. Now, when we are going, so the next one we're going to discuss now is basically entering a trade. So when you enter a trade, as I've said to you guys time and time again, this is where the discipline really separates a good trader from a bad trader, because entering your trade should always go off your analysis and your structure, your trend lines, and how you've identified everything. So you want to look at your entry rules as a checklist. So you don't enter based on how you're feeling. You're entering based on, okay, has it broken this pattern? Has it broken this trend line? Is it in the same direction as the impulse? If all of these things are correlating with each other, then you hit that buy button or you hit that sell button. So you always need to make sure you've confirmed the trend direction before you enter your trade. Always identify the trend and make sure everything is aligned on multiple time frames, not just the 15-minute. You want to make sure that your 1 hour, your 4 hour, and your daily is all aligned, even with your shorter term time frame. Because if it's not, of course, that's when you could potentially start to lose unnecessary money. So I'll go back to the charts again. So if I'm going to enter this, if I'm saying I want to buy this, right? I believe that we are going to start going up. We're going to do one more buy to the upside. What I want to do, I'm now looking for confirmation on a smaller time frame to confirm my analysis or my expectation that it's going to continue to go up. So I'll go on a 1 hour. If it looks like it's going to go down on a 1 hour, I probably won't care to sell if especially if I'm a longer term trader, I probably won't go into that. So long term, I'm seeing a buy. Short term, I'm seeing more potential sells. So what I'm trying to anticipate is what is going to happen once we start coming down again. And once it does come down, is that going to be my signal to go and buy it again? So if I've identified a buy, maybe I'm looking for this to go down to here. Maybe I'm looking at this as the impulse. And then once it does start doing this and I start getting a downwards trend, I'm now potentially looking at more buys. Now, as I start to see, if it does, considering it does the move that I'm anticipating for it to do, then I will start putting on my trade for the buy. But I'm not going to go and sell anything, especially as a long-term trader, especially if I'm looking at buys from a longer term perspective. So that's what I mean when I tell you guys, that's my 1 hour time frame. So my 1 hour time frame at this moment of time does not correlate with my daily, which means the long-term buy is not ready just yet. The 15 minutes also doesn't correlate with my daily. The 15 minutes is showing me that we still potentially got more sales, short-term sales coming before we get buys. So because my 15 minutes is saying that we've got more sales, because my 1 hour is also saying that we've got more sales as well as the 4 hour, I am now probably going to sit on my hands and I'm not going to get involved in the trade until I see additional confirmation for me to go in for the buy. So that is how I would, and it's not even how I look at the charts. That's how every single one of you guys should be trading. That's how you should be identifying your charts and looking at your analysis every single time you put on a trade. So only enter your trades when you've got a clear reason. So that could be a breakout, reversal pattern, or maybe divergence as well that confirms it. Remember, we've got to use our divergence, our other technical indicator tools as well. And once all of those are all in sync and is coherent with each other, only then should you be going in to your trades. Now, how do we exit? Because a lot of people know how to go into a trade, but not a lot of people are actually as effective when it comes to coming out of a trade. And with trading, people assume that you make money by entering, and if you're winning money, then you know you're successful. But a lot of people, believe it or not, they actually go into a trade when it's going in the right direction, but because they don't know when to come out, they actually end up coming out of a break even or they lose unnecessary money. So exiting a trade is just as important as knowing when to go into a trade as well. So that's one thing each and every one of you needs to bear in mind when it comes to your trading. Again, as I said in previous lessons, what tools do we use for coming out of your trade? You want to use divergence. So if you've gone in for a buy, share the chart again. So let's just say you've gone in for a buy for this. It's gone up. And then when it's gone up, you've seen divergence on a smaller time frame saying that it's going to go down again. That's a signal, a potential signal that you may want to come out and take profits. If you've gone up and it's hit your Fibonacci tool, your Fibonacci extension tool, let's just say it's gone all the way up here and it's hit your 38 fib tool, that's a possible indicator or a signal that you may want to start, with pulling out 50% of your losses or scaling out or even looking to fully, completely come out of your trade. It all depends on how it's gone to that point. If it's gone to that point impulsively, then what you can do, you can come out of your trade, you can scale out, let's just say 25% or 50%, knowing that you still got another portion of your funds left in the trade. You can wait for it to correct and as it corrects in again, you can scale in, open up another position and go into a trade again. So now you've got two trades running. But remember, when it goes to your take profit zones, you don't come out based on the fact that it's touched there. You come out based on the price action once it's got to that point. So if it goes to that take profit, it's gone very, very slowly. You're seeing divergence. You're seeing a reversal pattern formation form as well as divergence on the MACD. And it's also hit your 38 fib. What are you going to do? More than likely, you should be coming out of your trade. That should be a take profit to come out because you know it's going to be doing a deep correction before it goes back up again. So always make sure that when you are in a trade, try to really follow the structure, follow the reversal signals it's giving you so you can understand when is the correct time to come out of the trade. So have a clear take profit level. So when you're exiting a trade, you can take a partial 1-to-1 or you can take a 1-to-2 risk to reward ratio. Once the trade starts working in your favor, make sure you move your stop to break even. I do this all the time. Well, 9 times out of 10, I do this when I come to my trades. So if I've gone into a trade and it's cleared a certain threshold, I will move my stop to break even straight away. So I know that I'm not going to lose money, but that's only once it clears a certain threshold. So if it impulsively breaks out of that and it does a correction, and I can see that as moving to break out of the next correction, if I've entered here and my stop loss was below here, the moment it does this correction and it breaks out of it, I am now moving my stop to break even because I know it's cleared this threshold. So because it's cleared that threshold, I know probable, I don't know actually, probability dictates that it will still continue to go up once it's broken that correction. So whenever you get into a trade, always know when to move your stop to break even. Don't move it to break even as soon as you go in, because you can go into a correction. You can go in on that break here just because you see it going up. And traders do this all the time. You now move your stop to break even. And what the market usually does, it goes all the way back down there, retest that point, where it broke out of, it stops everyone out of their trade who had it in break even. And what does it do? It continues to go all the way back up again. So only move it to break even once it's retested, and it's broken out of another correction, then you can move a stop to break even. I hope that's clear for everyone. All of you guys, you've really got to try to understand this point here. It's very, very important when it comes to you trading, because this is what's going to make the difference between you continuously having break-even trades and losing unnecessary money in comparison to that person who is trading properly and is actually making money on a consistent basis. It's all about understanding, when do I move my stop loss, when do I leave it where it is, and when do I start trading. If any of you have any questions, please unmute your mic, because I do believe that this, in my personal opinion, when I first started to learn about all of these things, it wasn't 100% clear. So if something's not clear to you, please unmute your mic and ask me any questions. Cool. Well, if you ain't got any questions, we'll keep it moving. So that is how you go into your trade, and that's how you come out of your trade. So always look at the structure before you try to understand where is the market going to move next. So number three, so scaling in and out. Now, this is a very, very good strategy for people to have. A lot of, funnily enough, I didn't actually start using it. I started to use the strategy when I learned about it, but due to habits that I had in the past, I literally, when I went into a trade, I left it running. I may have been in like plus 300 points, and I would have left it just running at that. I wouldn't have even scaled in to optimize my wins. I would have just literally left it as that, which might have seemed good in hindsight. But really and truly, if you actually start learning how to scale in and out of trades, I'm telling you, that's going to allow you to generate so much your percentages on a quicker basis, and it's going to allow you to be so much more efficient when it comes to you trading as well. So really try to understand this part as well, because this is going to be it's going to be the difference between you being an average trader and you being a really good trader. So as I said, I overlooked it a lot, and a lot of other traders overlook it, but it's one of the best ways to actually optimize your trades and manage it effectively. So, what does scaling in mean? So, scaling in means that you're basically adding to your winning positions. So, if you're in a winning trade, you're up 100 points. What you could do, and what you should be trying to do, is add more to your position. So if you've added, let's just say, 3% to a trade, and you're 200 points up. So let's just say that's equivalent to 5%. You're currently 5% up. What I would advise, of course, you try to, I'd say first and foremost, try to just go into a trade, just, add one position, go into it, see how that runs. But once you start getting comfortable with the markets, really try to implement this strategy. So once it breaks another threshold, let me go into chart. This is the best way to identify it. So I've gone into a trade. I've seen a correction. As I've identified a correction, I've put on 3%, right? So I'm now risking 3%. That 3% is broken to the upside. Let's just say all of this, I'm winning. I've currently right now running about 5% on the trade as we speak, as it's broken to the upside. Now, what all of you guys should be trying to do is, if it does that and it goes to another continuation formation again, you add to your position again. But when you add to it, don't add the same amount of points you added when you initially went in, because now the market has gone further up to the upside or the downside. You want to add 50% of your initial position from your original trade. So if it's going up and you've put on 3% here, once it's done a corrective formation and you know it's going to go up again and you want to go into this trade again, what you want to do, you want to put on 1.5% of your trade. So which means that you're running 3% from this original trade here, and you're now running 1.5% from this trade here. So in total, you are running 4.5% of your trade. But the fact that you've locked in you've moved your stop to break even because it's cleared this threshold. You've now locked in again, means that you're not going to lose any money now. So regardless of what happens in the trade, there's no loss. You're only going to win. The only time in which you will lose is if it decides to break it and then come all the way back down again. But as I said to you before, if you've locked in your 50%, not your 50%, your break even stop loss, you don't stand to lose anything at all. So that is how you should be trading when you are in a clear trend. And you only want to take those type of trades when you are in a trend. Do not take it when you're in a corrective market. Only take it when you're in a trending market. Because when you're in a corrective market, as I've said to all of you guys before, the market will go up, it will go down, it will go up, it will go down. And then a week later, before you know it, you've now identified a correction, which might be a triangle or a flag or a pennant, which is indicating that it's going to continue in whatever direction in which it came from. So only do it in a trending market. So when you scale in, I would never advise you guys to scale into a losing trade. So if a trade is going against you on the other hand again, and it's gone back up and it's gone up, and you think that it's going to come back down to your original entry, I wouldn't advise you to scale into that because whilst logically you might try to you might try to make a rationale behind it. What happens if it doesn't go back in your favor again? That now means you've got two losing trades. So what that means is that instead of you potentially losing 3%, you're now potentially losing 4.5%, or in some cases 6% of your trades. So I only advise scaling into trades when you're in a successful trade, not a losing trade. And once your trade is in profit, the structure is holding, you can increase your exposure and you can just do it bit by bit as it continues to hold. And the reason why we do that is to make sure we capitalize on the confirmed momentum. So that's all we want to do. If we see the momentum, we're capitalizing, compounding, compounding. So that's what we're doing. Now, when it comes to scaling out of your trade, this is where you take profits in stages. So I'm going to show you a chart again. Everything I'm going to do is all going to come down to showing you a chart because that's at the end of the day, this is how we trade. So when you are in a trade which you believe is coming to an end, then and only then, if you've got multiple positions running or even one position running, what you want to do is start scaling out. So let's just say you're in this trade for the buy. You've bought it from this point here. You're currently running 200 points. It's corrected. You know it's going to go up again. But as it's going up, you can see that it's starting to give us reversal formations as it's going up. It's not going up impulsively. It's going up in a way in which is showing us clearly the trend is coming to an end. What you want to do, once it breaks that point, even though you know it's broken this correction, you want to now start pulling out at least 50% of your profits to make sure that regardless of whatever it does, you've already capitalized on at least 50% of the trade. But you only want to scale out, as I say, when you see the trend coming to an end. When the trend is starting and it's going strong, you scale in. When the trend is coming to an end, you scale out. Don't scale into and trade. Okay, let's take gold for example. A lot of people was buying gold, ridiculously. So let's go into gold. So, so this is gold, right? This was the original breakout of gold right here, as you guys can see. So it gave us a correction. It went up. It gave us another one, two, three, one, two, three. From that, it gave us another correction, as you guys can see here. And what did it do from that point onwards? It just continued to go higher and higher and higher. Now, if you had got involved in this trade from this small correction here, this descending wedge, you would have initially put on 3% from that initial trade. Once it broke this bigger correction, what you would have done from that point onwards, you would have scaled in. You'd have put on another 1.5%. So now you've got 3% running from this original trade, and you've now got an additional 1% running from the break of this correction here. And then what you want to do as it continues to go up higher and higher, you want to go into your smaller time frame. So I'm telling you how you should be taking this trade. as it continues to go up, you might then say, okay, it's giving us another corrective formation here. Let me go in again for a buy. But instead of doing 1.5%, what you're going to do, remember I said to you, every time you scale into a trade, you always want to reduce your percentage by 50%. Why? Because every time a trend continues, at some point, a trend is going to start slowing down and coming to an end. A trend is not going to go up forever. So if you do catch it early, the aim of the game is to put on your biggest percent at the beginning. And if you are coming into it late, you're going to put on a smaller percentage when you are coming to it late. So once it's giving you another entry, you now want to do 0.7%. So you've done 3% here, you've done 1.5% here, you've done 0.7% percent here. From your original trade, once it's broken that and it's gone up, you want to move this stop to break even. So regardless of whatever happens, you're always going to be winning this point here, this piece here. And then when you go into your second trade, you want to continue doing the exact same thing. Remember, what I'm explaining to you guys is not easy. I'm explaining it as if it's something that you can do just like that, but you will need to get into habit of just trading, putting on one trade first, doing that for a period of months, and then start this strategy. But what I'm saying, and I'll repeat myself once again, once you do start to adapt and develop this strategy and this way of trading, that's when you'll see your percentages grow ridiculously and you'll be taking so much advantage of the markets. So as you start to see divergence come in, what are you going to do? You're going to start scaling out of your trade. So these two trades that you might have gone into for the buy, as you start to go, let's say you saw divergence happening in this area here. You saw the MACD was doing lower lows. You saw the MACD. Oh, goodness me. So let's just say you saw the MACD doing lower highs and you saw the price doing higher highs. That's when you're going to start scaling at 50% of each of your trades. And you're scaling at 50% because you are now identifying that the price is coming to an end. If we put a Fibonacci here, I'm pretty sure that the reason why it broke or it rebounded from this point here is because it hit a major fib. Again, so if it's hitting a major fib, plus you're seeing it slow down in terms of its momentum and the divergence, then you want to start doing partial exits and coming out of your trade. I hope this all makes sense to all of you guys. Do any of you have any questions from everything I've just said?
Bro, I'm not gonna lie, like, wait, could you go back?
Yep.
Sorry, go back to it, go back to it. I just want you to explain like that last little bit. Because when you were putting out the MACD.
Okay, so
So when you started from the MACD when it was like it was going up and I think it was like coming down on that bit. Because you're saying how as it keeps going up, you wanna like bring back your like take out a little bit. So obviously you said start out at 50% initially and then as you're progressing then you're gonna go what scale down to like when you're scaling out, you're going down to 25%. Is that right? Sorry.
yeah, so in
Yeah.
in your original trade,
Yeah.
so are you talking about when you start taking your profits rather than putting on a trade?
Um, I'll say both only because I want like because it just saves time asking two more questions. So I'll
Cool.
say two.
So
Both.
when you are your very first trade that you go into,
Mm-hmm.
always do your original percent. So if you are doing 3%, you do 3% of that trade.
Okay.
Once it breaks a certain point and it gives you another correction and it breaks that, you can go in again. But when you do go in for the second time, don't close the first trade. The first trade's still running. You're just opening the second trade in the exact same
Mm-hmm.
direction. But now that you've got two trades running, this second one, you're now putting on 50% of what you put for the original trade. So if the original trade is 3%, your second trade is now going to be 1.5% risk that you're putting on. Make
Mm-hmm.
sense?
Yeah, that's mad. I didn't know you could do that. Sorry, I didn't know you could do that.
Yes.
Like mid tick. Okay.
And a lot of traders don't do this, myself included from time to time. I go into a lot of trades. I literally just have one trade running and that's it. But I think the reason why a lot of traders don't do this is because this strategy isn't explained enough. And this strategy is something that requires a bit more brain power. And if you imagine, once you've got three trades running in one direction, some people can get overwhelmed. And they're like, okay, well, when do I come out? You know, when do I start taking out the first trade or the second trade? So it's definitely something I would advise each and every one of you to start implementing once you get comfortable with putting on one trade. Cool. So that's that. And again, the exact same applies. So Joel, to your point, you want to start coming out of your trades when you start seeing the trend slow down. If the trend looks like it's getting stronger and stronger, keep scaling in. But if you see the trend slowing down, you want to start doing partial exits. Come out of your first
Okay.
trade, maybe do 50% of your second trade and your third trade and so on.
Oh, is it because like you see like I don't know. I don't know how to explain it, but you see how obviously you got the free trades going on at the
Yeah.
same time. Then depending, the first trade can make more money or greater profit than what your third trade or something like that.
Yes,
So
exactly.
then, like when it adds up all together, then it's like, all right, I don't know. Say for example, like all three trades add up to like I don't know, like £2 or something like that. But then from the profit of all three combined, you're making like I don't know, £5 or something like that. So would you?
Exactly. That's the reason for this strategy.
Okay,
That's
cool,
the
cool.
exact reason. Yeah. So, because the whole point behind this strategy is that you're not actually risking any more of your capital because you're already in profit. But instead of you winning or instead of you being rewarded 100 points, you're now being rewarded the equivalent of 200 points, risking the exact same percentage. You're not risking anything more. So that's why I said to you, you only want to do this strategy when you're running in profit. Never, I would never advise anyone to do what I'm telling you to do when you're in a losing trade. Otherwise, it can literally just result in you now risking 15, 20% of your account when you could have just lost potentially only 3% of your account. So it's not the idea between the strategies that it's not about being greedy, it's just about being strategic and knowing when is the best time to basically not abuse the markets, but to really kind of optimize the amount of money that you can get from the markets.
Okay, cool.
Cool. So yeah, so that's that. It's a very it's I would say it's probably one of the most powerful strategies that anyone can use when it comes to trading. And if you get your head around it, then literally it will put you in a minority of successful traders, especially if you're doing it consistently as well. But remember, only do it in a market that's trending, not a market that's in a corrective formation. Cool. So risk versus aggressive risk. Okay, so this one again, this is another very good strategy, which all of you guys really need to kind of be a bit be very intentional about and make sure you are bearing these things in mind when it comes to entering the trade. So, understanding risk entries versus aggressive entries is very important. So, with a risk entry, that's what most traders should be focusing on when they're learning. I wouldn't advise any of you guys to get into aggressive risk trade entries until you start becoming very confident and comfortable with the markets. So, when you're in a risk entry trade, basically what you're doing, you're waiting for confirmation. So, you're waiting for a break of your formation. Again, I'm going to share the chart again. Let's go to a different chart this time. So, as a matter of fact, let's go here. Right. So, a risk trade, right? So, this is generally speaking what 8 out of 10 traders do. They'll identify a formation. So, let's just say you've identified this descending wedge here. It's broken it. Once it's broken it, you then wait for a retest. It might retest on the 5 minute, it might retest on the 15 minute. But the moment it's retested it, you're now going in for a buy. It's broken it, it's retested it. That's your sign, that's your signal to go in. Of course, what you guys can see here, if somebody went into this trade and then moved their stop to break even just because they saw it going up here and they moved it to break even there, what's going to happen? The chance, well, you've lost unnecessary money because you've moved it to break even. But as you can see, it's retested it even down to this point here. If you kept your stop below this formation, you'd still be clear from the trade. Can you see? You'd still have an area where it wouldn't have stopped you out. So that's a normal risk entry trade. Now, this is where it gets a bit more probably exciting. So a aggressive trader now, they will say, okay, I've got this formation here. It's done one down, it's done one up, it's done a down again. Within this down here, they will say, okay, I believe this is going to go to the upside. So even though it's not actually broken anything, I'm actually going to buy it from here at its lowest point. Now, there's a lot of different indicators and things that people use to give them that confirmation to go in for the buy. But simply put, that's the difference between a aggressive trader and a normal risk and a normal risk entry trader. So a risk entry trader waits for a break and a retest, whilst an aggressive trader sees what they believe to be the structure or the formation from a correction, from an impulse, and they say, okay, I know where it's going. I'm just going to go in. And then I'm going to have my stop as a minimal entry, a stop loss at the lows. And then if it takes me out, fine, it takes me out. But if it doesn't, then I've basically just capitalized on all of that. Now, when you're doing a aggressive risk trade entry trade, generally speaking, your stop can be very, very tight. It doesn't need to be as big as the normal risk entry trader. So if you're a risk entry trader and you've gone in at this break here, your stop now needs to be below this point. So this is where your stop needs to be, which means you're going to have quite a big stop. Now, if your stop is bigger, that means that you're going to have to make sure you compensate for more pounds per point, meaning that your pounds per point is going to be smaller. It's not going to be as big now. So a normal risk entry trader would probably, let's just say, for example, would put on 50p a point if they was waiting for the break here. But a aggressive entry trader would now be able to put on £3 a point because they've now got a minimal stop. Do you get it? So because they've got a minimal stop, once that does start going up and it starts going in their favor, they're now potentially going to be gaining a lot more percentages in terms of the value of their money rather than someone who waited for it to break. But as I said to you guys here, to be able to do stuff like this, it requires a certain level of skill and it requires a certain level of experience and time of you being in the markets. There's different things that you can watch out for to confirm it. So a lot of aggressive traders, what they tend to do, they'll see this correction here, and then they'll say, okay, let me go into the very, very small time frame to see what's going on. So they'll say, okay, cool. Let's go into the 15 minute. They'll go into the 15 minute. And then what they're doing, they're now looking at this as a trend. So they're saying that's the trend. It's done a 1, 2, 3 down. And they'll say once it's broken out of the structure, that's where they're getting in from that point there. So generally speaking, if you do want to get into into aggressive trading, what you're going to find yourself doing is going down into the very, very small time frames. You might even go down into a 1 minute time frame to get your entry for a trade that a normal risk entry trader wouldn't have identified. Most people with this sort of analysis is looking for a break of hair, or they're going to go in on the retest here. Whereas the aggressive traders actually got in way early before anyone else and they've got a minimal stop below there, which means they're taking full advantage of the price action and where the price is going from that point onwards. So to be aggressive, go into your small time frames, your 1 minutes and your 5 minutes. But again, try to understand and execute the basics before you start trying to run. It's all about, learning to crawl then learning to walk, then learning to run. Don't start off in the markets and say, I'm going to start going on 100-meter sprint straight away because you're just going to fall and end up losing unnecessary money. So that is, really the core difference, being able to anticipate a correction before it's happened. So in my advice, whilst you're still refining your skill and building that level of consistency, stick to risk entries. I would advise that for each and every one of you guys who are only just starting with the trading. And once you've got that strong hit rate, you can see out of every 10 trades, you're hitting eight correct, maybe seven to eight correct out of every of your 10 trades, and you've got a good amount of confidence in the markets, and you know your analysis is looking really good, then you can start to experiment with the aggressive entries. And then and also when you are doing aggressive, make sure that everything is in alignment. Make sure the 1 minute to 5 minute aligns with the 1 hour, and make sure the 1 hour aligns with the daily. So always bear that in mind, regardless of what time frame you are scaling down to. So we've got literally 3 slides left, no, 2 slides left. I'm gonna go on a 3 minute break, and then let's do these 2 slides, and we should be wrapping up for about 8:15. So 3 minutes, and then we'll start back again. Hey guys, so we are back. Sorry, we're actually on our last slide, funnily enough. We didn't even need to go for a break, but hey. So mindset now, I mean, this one, again, I will say this all the time, and I will sound like a broken record, but the mindset is one of the most, is probably the most important part for everybody to consider here. So it's all about making sure that you are confident in your execution of your trades, because it's that mental confidence that's going to allow you to enter at the right time, not procrastinate, and it's also going to allow you to come out of your trade at the right time as well. So Confidence, it doesn't come from being motivated or it doesn't come from luck. Nothing, as I said to you all the time, it comes from discipline, it comes from repetition. And when you've seen your setups play out over and over again, and you've done your back testing and you're in the markets live and you've done it over a period of time, that's when your belief starts to form. And as your belief continues to form, you'll just get more and more better at being in your flow and taking the trades that you see rather than second guessing yourself. So once your plan gives you the signal, you guys know exactly what we need to look out for in terms of the trends, the waves, the breaks, the impulses. Once it gives you that signal, trust it and take the trade. Do not hesitate. Don't overthink it. Just take it. And it's the consistency in what you do that's going to build a confidence. So confidence, and I've said to you before, confidence doesn't mean you're not going to lose. You will lose. Trading is a game of probabilities. It's not a game of perfection. So when you do lose, and if it means that you lose as well, you just need to take it, shake it off, and then just keep going. Because that's why I said to you, what you always want to check your progress over a quarterly basis, because quarterly, every 3 months allows you to see quite clearly if you've been doing good over a long period of time or bad over a long period of time. If Q1 and Q2, you've been consistently losing, then the chances are you need to do something about your strategy or do something about the way in which you trade. So that's always a fair benchmark I would give to people when it comes to looking at their trades. And remember, when you lose, you always take your losses as a lesson. So, what feedback are you gathering from your loss? What could you do better? And then when you win, your win just validates the fact that you know what you're doing. So just remember that the best trades, they don't control, like the best traders, they don't control the outcome of the markets. They control how they react to the price action of the markets. And we're never going to master it. None of us are. It doesn't matter if you've been trading 5 years, 10, 15, 20 years, you're never going to master the markets. It's all about you really making sure that you're consistent. And by the end of every 12 months, you're up. Whether it's 50% or 100%, you're up. Because as long as you're up, you're doing good. That's what it boils down to at the end of the day. And just the key takeaway. So that's everything we've discovered. That's everything we've discussed today, really. So we focused on intraday versus swing trading. So really important to ask yourself. So go into, I can't tell you guys what's best for you. Only you know what's best for yourself. If you guys are working every single day, and you can't be in front of the markets in the morning, afternoon, and the evening, then you might be better suited for a swing trader. If you do have the time to look at the markets first thing in the morning, your schedule's a bit flexible, and you can actually track it and see what's going on, then yes, you can be an intraday trader as well. If you're patient and you don't mind seeing things go up and down over a period of a week before it finally goes up, then you can be a swing trader as well as an intraday trader. As I said, I do both. I'm in the markets every single day. I track it. I take trades when it's necessary for me to trade. And then if I see a long-term trade, if I've taken a trade for US 30 and I've caught a really, really good trend, I'll more than likely stay in that trade for weeks if so be it. But that's only considering I've caught a strong trend. If I'm looking at the US 30 and then I've caught an up move and I can clearly see it looks like it's going to come down a week later, then of course I'm no longer going to be an intraday trader. I'll no longer be a swing trader. I'll probably convert into an intraday trader and take it for what it's showing me at the time. So just remember that you guys could bounce between both, and it's okay to bounce between the both. So everything we've covered today, so it's all about making sure that your exit is timed properly, your entries are timed properly, understand when to scale, and understand whether you're going to take a aggressive entry or a normal risk entry trade, and making sure that when you are taking these trades, you are confident in what you're seeing and what you're taking. Don't do the aggressive ones until you become more confident. And just remember, it's all about consistency as well. So that's kind of everything for today, really. So that's when you take away this lesson, look into the PDF, which I'm going to chuck into the group, and really just compare it with your lifestyle and your personality, and just ask yourself, what is best for me, and when can I start using these more enhanced strategies as I become more comfortable with the markets. Yep. So that's all. It was quite a decent, quick session, but I hope all of you took all of that on board, and I hope everything was clear from what I explained to all of you lot as well. Is there any questions that any of you guys have before we jump off the call? No questions at all? Cool. I think we're good to go then. All right then, guys. Well, enjoy the rest of your evening. Again, I will try to get this recording out by Wednesday, Thursday latest. And if I don't, I'll give you guys the heads up if I don't as well. So I will send this PDF in a group so you can refer to it and then keep moving from there. So other than that, enjoy the rest of your evening and we'll catch up soon.
Yeah,
Thank
man.
you.
Thank you, love.
No worries. All right. Thank you.